We are headed for an economic collapse that will rival the global financial crisis, and our response to it will determine whether it's even worse than that. Think about the run-up to the global financial crisis. The housing market was a single ticking time bomb with an enormous blast radius that few understood at the time. So it's difficult to imagine what it would be like if there were more of them. Repo market stress, private credit market liquidity crunch, subprime lending crisis, spiraling deficits, basis trade exposure, dollar debasement, U.S. states in recession, oil market contango, tariff and trade war. Explosive devices have been set all around the economy, and a new bomb was just uncovered in the most unlikely of places. Now, much of this story isn't the Trump administration's fault specifically. Some of it is exclusively their fault. All of it is now their problem. UNFTR. Today we have two financial systems, one that was stitched together in the wake of the 08-09 crisis, and the one that developed adjacent to it. This secondary market is now as big as the primary banking system. Now, the technical name for it is non-bank financial intermediation, or NBFI. But most in the industry just call it the shadow banking system. Now, it sounds conspiratorial, but it's for real. And for our purposes, we'll continue to call it the shadow banking system. And this includes money markets, hedge funds, venture capital firms, and sovereign wealth funds. Now, a significant element of the shadow banking system is lending, or private credit lending. The part of the shadow system that has grown dramatically in the wake of the financial crisis for two reasons. The first is regulations. The second is capital requirements. See, the Obama administration and the first Obama Congress moved quickly to shore up the financial system by coordinating Federal Reserve and Treasury activities to flood the banking sector with liquidity and provide incredibly low-cost capital. The Federal Reserve purchased toxic assets from bank balance sheets. The government purchased shares of corporations so that they had the cash to work through their own toxic debt. And it developed a system of reporting requirements for banks of all sizes and increased the amount of money that banks were required to keep in reserve balances. And then it stopped there. What didn't stop was the flow of capital to the banking sector at near zero interest rates. These factors continued long after the large investment and commercial depository banks had worked through their toxic debt issues, so money was both cheap and available. It was like leaving a toddler in a candy store and saying, "Don't touch anything, I'll be back in a couple of years, just keep an eye on things." So because the regulations and the capital requirements remained in force, the banks technically couldn't invest in risky activities, right? So they just found other ways to do it. The simplest way to explain the buildup in tension outside of the banking system is to keep in mind the concept of cheap and easy money. As long as financial institutions have abundant access to cheap money, they're going to find a way to deploy it, and that's exactly what they did. Parking money in the shadow banking sector is the easy thing to track. All we have to do is look at the growth of investment firms like BlackRock and Apollo to know where the money is flowing. But because these firms aren't held to the same regulatory standards as the banks, they need to only maintain solid payment records on the money that they receive from the banking sector, so everybody just gets high marks from the credit rating agencies, just like they did in the housing crisis. But this is only one part of the story. It turns out that these shadow institutions had another source of investment capital all along, the U.S. Treasury. And this, my friends, is where our story really begins. I want you to think of the U.S. economy as a giant building. And at the foundation, you have the banking system. This is the substructure that controls all of the operations. You've got the elevator room, heating and cooling, power and electricity, plumbing. Now, above ground, you have the real economy. And on the first several floors, we've got manufacturing, agriculture, service industries, and they're ingesting the airflow, the power, and the water from the banking system below just to make the operations hum. And at the very top floors, you have the government entities that keep watch over them. They provide guidance and defense. Now, the employees of all of these places are in their offices and in their cubicles. And that's you, me, the bankers, welders, doctors, everybody. Now, if one of these floors suddenly fails, maybe the air conditioning stops, all of the employees quit, the plumbing stops, whatever, the rest of the building typically has the capacity to absorb the shock. And the powers that be from the top floors come in and they assess the damage and work with the substructure to fix it all. It's a very sophisticated system. It's almost a living and breathing system. Now, if you want to take down a building of this magnitude, you would have to do more than just plant a bomb on one of the floors. This might do some temporary damage and hurt a lot of people, but it's unlikely to take the whole thing down. To take down a building of this size, you would have to do controlled demolition and attack it from all angles, both inside and out. So let's talk about some explosives. Mark Zandi from Moody's Analytics set off a brief firestorm when he released indicators showing that 22 U.S. states plus Washington, D.C. are already in recession. That's nearly half of American states in economic decline right now, while the White House keeps telling us that everything is tremendous. Zandi's state-level recession index isn't just looking at employment numbers. It's drawing on jobs data, personal income, modeled industrial production, housing starts, credit performance, and migration patterns. And what it reveals is a patchwork economy with startling differences from state to state. The recession-impacted states are geographically scattered, but they're concentrated in the Midwest, the Plains, and the Northeast. So what do these have in common? Well, federal job cuts for one, especially around D.C., slowing immigration that had been filling crucial labor gaps, rising tariffs that are hammering trade-exposed regions, and declining manufacturing sectors that are facing weaker demand for goods as global trade contracts. That part doesn't get enough attention, by the way. We're 6 months into the heart of Trump's tariff regime, and manufacturing isn't gaining ground or stabilizing, it's losing ground. Now, here's where it gets interesting. While 22 states are sliding backward, another third are just treading water, barely keeping their heads above the surface. But there's this group of southern states, South Carolina, Florida, Texas, North Carolina, for example, and they're all in expansion mode. Why? Well, strong population inflows for one. Census data shows that the South has seen massive in-migration since 2020, driven by affordable housing, lower taxes, and ostensibly business-friendly environments. These states experienced a boom in real estate and construction as a result of the post-COVID migration. And more people also means expansion of services, so professional services, healthcare, financial activities, leisure and hospitality. So this inflow has provided some temporary insulation. Not to mention, defense and aerospace investments have also benefited southern economies as one of the few areas where the government spending has increased. So states like South Carolina, as an example, are leading the nation in personal income increases and job gains, outpacing national averages. So on paper, they look great. But here's the problem. And this is where the Trump administration's policies become a ticking time bomb, even for states that are currently thriving. The government shutdown over federal Medicaid support is vital to understanding what's at stake for the economy. Many of the not yet in recession states are the ones with the highest reliance on Medicaid support from the federal government. Mississippi gets 81 to 82% of its Medicaid costs covered by the federal government. It's the highest in the nation. And Medicaid represents about 25% of the entire state budget. Kentucky is at 81% of federal support, and Medicaid makes up 33% of their budget. New Mexico, 80%, covering 34% of their budget. West Virginia, Arizona, Arkansas, Alabama, South Carolina, Oklahoma, all receive between 70 and 80% federal funding for Medicaid, with the program representing anywhere between 22 and 30% of their state budgets. So what happens if you slash funding to a program that represents a third of a state's budget? It's a nightmare in the making, and it should be noted, by the way, that most of these are red states. So it's unbelievable that we have Democrats standing up to red state Republicans over this particular issue. See, these cuts will force states to impossible choices: either raise taxes dramatically during an economic slowdown, or gut things like healthcare, education, and any other services. Either of these options kills jobs. So this first bomb is state budgets and the prospect of mass layoffs and surging demand for social insurance programs from the Trump administration trying to gut them. So let's talk about a phenomenon called contango. Right now, crude oil is trading below $60, which means most U.S. oil and gas companies are losing money on drilling. Contango, with respect to oil markets, means that oil traders expect prices to be higher in the future than the spot prices today. This might sound like a good sign for oil traders, but this specific scenario is actually a negative sign. Contango is a giant red flag that demand for oil is weak, which points to broader economic problems, slowdowns in global manufacturing, reduced shipping activity, less air travel, and stuff like that. So when businesses and consumers are using less oil, it tells us that economic activity has slowed down significantly. Maybe because of reduced consumer spending, maybe softening industrial output, maybe just financial stress spreading across countries. Persistent contango, especially when accompanied by rising oil inventories, is usually a warning sign that the world economy is experiencing a slump or that a recovery has stalled completely. And here's the direct connection. Trump's tariff war has artificially slowed down global trade projections. Remember, all those companies that front-ran tariff deadlines by rushing to import goods before the new taxes hit? That moment artificially propped up the global freight market for months. But now, orders are slowing. Hiring forecasts for the holiday season are dismal. Layoff announcements are accelerating. The contango in oil markets is directly related to Trump's policy chaos. It's the physical manifestation of global economic uncertainty caused by one man's inability to just understand how trade works. And this brings us to our next time bomb. Dollar debasement. So this refers to the sharp and highly publicized decline in the value of the US dollar throughout 2025. And we're not talking about a minor adjustment here. The US dollar index fell by nearly 8 to 11% in the first half of the year, marking the most significant depreciation since the 70s. I mean, think about that. The worst dollar decline in over 50 years. So investors have responded by shifting assets away from the dollar and toward inflation hedges, especially scarce assets like gold and silver and even Bitcoin. And this movement has a name. It's called the debasement trade, where investors seek scarce assets as a protection against a declining dollar. So what's driving this? Well, ballooning U.S. budget deficits for starters. There are also building expectations of easier monetary policy coming soon, meaning investors know that the Fed is going to have to engage in some sort of form of quantitative easing again. Then there's the persistent inflation despite interest rate increases to hold it in check. Global de-dollarization with central banks around the world actively diversifying away from the dollar. Political uncertainty about U.S. fiscal sustainability. The weakening dollar raises import costs for American consumers as well, which could reignite more inflationary pressures. So we can't even take advantage of those cheap oil prices. So it erodes the real value of dollar-denominated savings and bonds. Sure, a cheaper dollar provides some support for U.S. exports, but again, manufacturing is only 10% of U.S. GDP. And as we've said before, this is shrinking, no matter what Trump tells you. And people like Scott Bessent will tell you that the U.S. Treasury auctions are still finding buyers, and that's fair. But what we don't know, which we'll talk about, is who's doing the buying, because the buyers have changed dramatically. So we're seeing a shift from institutional investors, those stable, long-term central banks and pension funds, to private buyers. That's not a sign of strength. And more on this when we talk about the hidden bomb in the building. There were two high-profile bankruptcies in early October, Tricolor and First Brands Group. And these raised eyebrows on Wall Street at first, and then alarm bells when two regional banks disclosed trouble on their balance sheets. So these events prompted JP Morgan Chase CEO Jamie Dimon to remark on an investor call, quote, "And I probably shouldn't say this, but when you see one cockroach, there are probably more. Everyone should be forewarned on this." Now, the stock market reacted negatively at first and then quickly reversed to continue its remarkable bull run. And when the dust settled from the announcements, most came to believe that these were indeed isolated events related to fraud. So in the case of First Brands Group, it was disclosed that as much as $1.9 billion from its lending arm had just disappeared. A clear case of fraud. So Zions Bank and Western Alliance, the two regional banks that reported potential loan losses, were both purportedly related to the same borrower, a group called Cantor Group in California. So Wall Street's sigh of relief that the troubles of Zions Bank, Western Alliance, and First Brands Group are likely related to fraud and poor underwriting obscured the first domino in the October uneasiness: Tricolor. See, Tricolor is a subprime mortgage crisis throwback, but in the auto loan sector. Most of its borrowers didn't even have a credit score, and get this, more than half of them didn't have a driver's license. And yet, the loan volume was so robust that it counted Fifth Third Bancorp, Barclays, and JP Morgan Chase among its capital suppliers. This is how the subprime shell game continued after the global financial crisis, and it's hauntingly similar to what happened in the housing crisis. Highly regulated banks are still engaging in risky lending practices, but they're maintaining an arm's length distance. A staggering amount of commercial and residential loans, business, student, and auto loans, and risky revolving lines of credit are issued through these NBFI or shadow banking institutions, but the capital originates from the banking sector. And since the Dodd-Frank regulations implemented after the financial crisis, the banks have increased the supply of capital to these private corporations like hedge funds and venture capital firms and investment banks and private credit firms. This is where the term off-balance sheet comes in. These are massive lines of credit or facilities, and so long as they're receiving regular interest payments back at the banks, there's just an assumption that everything is healthy. The only problem is that we can't see the individual loans and portfolios on the private side of the ledger. All we can see is whether they're customers of the banks and whether the banks are getting regular payments. For example, Wells Fargo might show a healthy lending relationship with a high-profile firm like Blackstone or Apollo. And these firms are so well capitalized that if a small percentage of their lending portfolio was under duress, we wouldn't even know it. But there are mid-market and subprime market lenders like Tricolor that are themselves enormous, and they've staked out risky positions in commercial and residential lending. So these lenders might have secured facilities at 200 to 300 basis points above the federal funds rate. And in return, they lend money to the secured and unsecured marketplace, all of us, at 9 to 15% and maybe even higher. So if a handful of these loans run into trouble, lenders could repackage them at lower rates to maintain a healthy balance sheet. Some firms are engaging in what's called payment in kind or PIK loans, where they take equity of their borrowers in lieu of interest and principal for a period of time. And so long as these troubled loans don't fail en masse, the surface of the banking sector and the private credit market looks to be stable. But if all of a sudden, as happened from 07 to 08, a wide range of loans go south, these cracks turn to chasms. In other words, we might have more than a family of cockroaches living behind the cabinets. We might be facing a whole house infestation. So in the most basic of terms, the money in the banking system comes from the Federal Reserve. So the Fed loans money to banks at favorable rates in order to capitalize them. And in turn, these banks lend money to the world and earn the difference. So in our scenarios, the Fed loans money to the banks who loan money to customers, but also to other lenders who loan money to the public. There's a lot of hands on this cash. And importantly, banks and corporations will also use this money to purchase treasuries from the government at set interest rates so that they always have a nice guaranteed buffer. Every so often, though, the broader market becomes illiquid, meaning there's more money in loans that have to be settled out than the banks have in cash on hand. And so things get a little tight. In these instances, the Federal Reserve will supply additional money by either printing additional banknotes and buying securities from the banks, replacing assets with cash, or by releasing money from a rainy day fund called the Standing Repo Facility. So here's just one problem that we have at the moment. The Standing Repo Facility, that rainy day fund, is empty. That money has been depleted because the Fed has had to purchase treasuries to fill the U.S. Treasury bank account. Why? Because we have to fund the government. And the deficits are growing wider and wider because we refuse to tax wealthy people and corporations. But now for the scary part. At the end of each fiscal quarter, U.S. corporations move a ton of money around to try and clean up their books for quarterly reporting. And twice a year, they sell a bunch of securities to pay taxes. So during these very predictable times, the Fed will pump up liquidity to make sure that everybody can buy and sell whatever they need. But on several occasions just this year, prior to October now, it hasn't been enough, and so they've had to step in to inject even more money into the system. So what you see here is the liquidity injection prior to October fell on quarter-end days and tax deadlines. So again, not unusual, not a great sign, but not unusual. And then something broke in October. Firms have repeatedly dipped into the Fed repo operations to secure enough liquidity for all market settlements. Now, while the total daily volume is in the billions of dollars and therefore entirely manageable, the point is it shouldn't be happening at all, let alone repeatedly. The only times this has happened in recent memory is COVID. We can't even look to the global financial crisis for guidance because many of these were backstops that were created in the wake of and because of it. So this is all new stuff. And it's unsettling because it means that the private credit market might be running out of money and it might be bleeding over into the commercial market. So when things like this happen, it sends a signal to the managers of the U.S. economy, not just the Federal Reserve. These are the moments when the heads of the U.S. Treasury, the Federal Reserve, Senate Banking Committee, the White House, the nation's largest banks who are also members of the Fed, the Council of Economic Advisors, everybody assembles to address the broader issues in the market. Because only government oversight can compel these companies to open their books so we can stress test this important shadow banking sector. Otherwise, we're all in the dark. And right now, the Fed chair is under fire from the White House. The head of the Treasury is actively running the effort to replace him. The president is completely out of touch in building ballrooms and bombing boats in the Caribbean. And the big banks? Not for nothing, but these are the same people who destroyed the financial system just 15 years ago. Now, this is all brand new information, and I don't think the world or the markets have really wrapped their minds around it yet. In July of 2025, the Financial Stability Board, an international body that monitors the global financial system, issued a report called Leverage in Non-Bank Financial Intermediation, and the paper takes aim at the lack of oversight into the shadow banking market and the amount of off-balance sheet leverage in the system. So essentially, banks are allowing these shadow banking firms to gamble on loans and securities with extreme leverage, sometimes upwards of 100 times. So the upshot of the FSB report is that there's first-party and counterparty risk all over the globe in these very opaque markets. And this is an important piece of it because the FSB is an international organization. They're warning of global systemic risk, not just U.S. risk. But our increasingly globalized world has made all of these markets interconnected and interdependent. So a collapse of one or a few markets in the US, for example, would have a ripple effect throughout the entire global economy again. Now that's the backdrop to explain maybe the most bizarre revelation that we've had in recent days. Consider this statement that is the closing line from a recent report from the Federal Reserve. Quote, "The puzzling disconnect between the TIC and Form PF data on Cayman Islands holdings of U.S. Treasuries is under active investigation." I'm going to unpack this statement fully in a bit, but again, a little more context here. Because the U.S. is running such extravagant deficits, it's had to issue more and more debt through Treasury auctions. Now, the Sell America narrative began to take hold in April of this year when Trump announced Liberation Day. Recall that the administration almost instantly backed off the most extreme rhetoric because of the extremely negative response in the bond markets, thus earning him the nickname Taco, or Trump always chickens out. See, when the bond market collapses, suddenly it presents enormous risks to the global markets. And once again, because of the amount of leverage in the system, everybody was spooked, including Trump. And as insane as it sounds, the Treasury market is a gambling market with trillions of dollars flowing through it. And there's something called a basis trade. This is a very common trade in the commodities market because it allows participants to hedge against price fluctuations in the future. And it turns out there's a staggering amount of basis trading in the Treasury market as well. So basically, every bond has a futures contract associated with it. So you have the present day bond and then what it might be priced at in the near future. And in a basis trade, an investor will purchase whichever one is cheaper and then sell the more expensive one and hope that over time, the values of them converge. So when you close these positions out, there's a very small amount of profit, and I mean very small. So because the Treasury markets are essentially commodities markets, the Treasuries are stable and short-term notes aren't all that volatile. So because Treasury markets are so stable, they're almost perfect for basis trading because they're the closest thing to a lock that you can get in this type of activity. Problem is, again, there's not a lot of money to be made. The margins are very small, and that's where leverage comes in. So these shadow banks, most notably the hedge funds, are very active in these markets. And in order to make these trades worthwhile, beyond just the value of the Treasury holding themselves, they borrow excessive amounts from the banks to leverage these trades. So they might have 50 to 100 times their actual position to make in the trade based on the leverage they get from the banks. So this means that most of the money in the Treasury markets held by these hedge funds is borrowed. So what happens when that sure thing becomes a little less sure? And this is where everything converges. Because the margins on basis trades are so slim, even the smallest disruption can trigger massive losses, forced selling, or systemic distress. This is what regulators like the Federal Reserve and the FSB have been highlighting as potential systemic risk to the global markets. These leveraged funds that operate through offshore entities in the Cayman Islands just so they can take advantage of less regulation. And it was understood for quite some time that hedge funds have significant exposure to U.S. Treasuries. Fine. Everybody knew that they were buying them and selling them. And for years, foreign central banks have been moving away from purchasing U.S. Treasuries. But this trend accelerated when Trump was reelected and went on the warpath against our trading allies and our foes alike. And the combination of America First policies that gutted foreign aid and an all-out tariff war with the world forced foreign central banks, referred to as official sources, to reduce their holdings of treasuries in favor of other currencies and physical commodities like gold and silver and Bitcoin. And despite this trend, U.S. Treasury auctions to fund our ever-increasing appetite for debt continued with relative ease, but from private sources instead of official sources. These private sources just moved in to take over these positions. And this gave the Trump administration the ability to sort of claim that the bond market and the whole that was stable and that the whole sell America narrative was false and overhyped. And then on October 15th, the Federal Reserve released a paper that can only be considered a bombshell. See, up until this paper was released, it was believed that hedge funds held around $400 billion in short-term treasuries. The amount came from the TIC data, or the Treasury International Capital data, and we've spoken about that here before. The Federal Reserve, though, dug into what's called Form PF filings. These are hedge fund trading disclosures to the SEC, and they uncovered something very, very different. The Form PF filings show that hedge funds registered to the Cayman Islands are holding on to more than $1.8 trillion in U.S. Treasury securities. This is mind-blowing stuff. The fact that the two primary economic agencies in the country and in the world have a $1.4 trillion reconciliation problem is alarming. But even more troubling is that these hedge funds aren't purchasing treasuries to perform their patriotic duty or just earning the stable returns. No, they're leveraging them to the hilt to profit from the basis trade. So that means that any marginal disruption, any changes in value to the upside or the downside, any variation beyond the expected maturity means that these hedge funds have enormous exposure. It also means that our debt is held by what can only be considered a Ponzi scheme. Put it all together. This is the definition of a gathering storm. Our deficits are increasing daily, and so is the cost to finance them, no matter how hard they work to get those rates down. The repo market stress reveals liquidity strains in the capital markets. The implosion of subprime lending markets, from student debt to auto loans, signifies a hollowing out of the lower end of the economy. Extreme leverage in the private credit markets is bleeding out, with signs of defaults and fraudulent activity. And the disconnect between the U.S. Treasury and the Federal Reserve couldn't be more extreme at the precise moment when close coordination is absolutely paramount. And I'll add one last layer to the equation. The 2020 pandemic masked what was shaping up to be a business cycle recession. Several key indicators outside of the stock market demonstrate in hindsight that we were likely heading into a shallow recession at a minimum. Maybe something bigger, but definitely a shallow recession. And that would have made a lot of sense considering that we were due for a late cycle downturn. Instead, we injected $4 trillion into the economy over an 18-month period. A flood of deficit liquidity, combined with a forced shutdown of the global economy and a complete reordering of the supply chain, caused all of the economic indicators that we normally rely on to predict market activity to go haywire. So visibility was already reduced coming out of COVID. But these explosives hiding in the corner of the economic edifice we live in would have been hard to spot, but not impossible. See, had we stayed on the course with a highly technocratic democratic regime, we might have the ability to present a unified front and a coordinated response to a forestalled downturn. Think Obama and the global financial crisis recovery, right? It would have been insufficient and slow, and the consumer would have paid the price to bail out the bankers again, but it would have been familiar at a minimum. Painful, but familiar. Instead, we elected a guy who chose to put his own explosive devices all over the building to help with the controlled demolition of the economy. Slashing taxes to further deplete the treasury coffers, imposing the highest tariffs in history on all of our trading partners, reducing regulations on the financial markets, and just to add more gas to the fire, he's pitting the only two agencies that can save us against one another. Again, repo market stress, private credit market liquidity crunch, subprime lending crisis, spiraling deficits, basis trade exposure, dollar debasement, 22 states in recession, oil market contango, and a tariff and trade war. These are the explosive devices planted in every corner of the economy, and that doesn't even touch the hard economic data like unemployment, inflation, housing, and consumer debt. If ever there was a time for steady hands and brilliant minds to create a plan to completely reorient the economy away from the top 1% and toward the 99%, it's now. And instead, we elected a human Molotov cocktail dead set on setting the whole thing ablaze. But hey, at least we'll have a new ballroom to show for it all. Thank you for sitting through that missive. I hope it helped explain some of where we're at right now and at least inspires you to learn more about the economic crisis that we're facing right now, because knowledge is power. We're only going to get out of something if we understand how we got into it. I also want to thank everybody that's participating in our fall Fund, Friend, and Hellraiser period to help us grow this channel and help us expand UNFTR. The members are the lifeblood of everything that we do, from the website to the newsletters to this channel and to our podcast. We're entirely member supported, so we rely on all of that kind of support. Right now, we're running to get to 600 members. We're at around 450 right now. If we can get to 600 by the end of this fall fundraising period, we'll be in really good shape heading into next year to kind of keep the hammer down and keep giving you the stuff that you love. So thank you to all those that have participated, especially these fine folks who have engaged with us at the professional and over-caffeinated tiers.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Started a podcast. Another basic white guy who started a podcast. But it's fun because he curses all through the podcast.